Hello, everyone, and thank you for joining us today on the Dairy Signal. We're going to dive into a market update here in just a moment, but I have a fun fact for you to start out your Thursday afternoon on, and that is that, we most of the time think about that iconic Mickey Mouse character and his debut happening in Steamboat Willie. But fun fact, it was actually on this day in 1928 that he made his first screen debut and a test screening, and it was actually in a little short 6-minute film that was called Plain Crazy that had not only Mickey Mouse but Minnie as well. So that is your fun fact for this afternoon, probably bringing you back to your childhood for a little bit. But let's really dive into what's going on in the world of markets around us. And joining us this afternoon is Ben Buckner. So Ben, I'm going to hand it right over to you to get us started.
Well, thank you so much, Amber. Always a pleasure to be a part of the Dairy Signal. And there is a lot going on. Even just today, we've got cross currents that include trade negotiations, biofuel policy, maybe positive, maybe not, macroeconomic landscape, weather, export demand. So we want to communicate, kind of start this off by saying, I think again, we're not negative of dairy markets. In fact, I think we're getting increasingly positive based on, normal seasonally bullish price trends. And also, finally, we're seeing export demand because the world market continues to go up. That I think is the beginning and end of the outlook between now and September, October. The feed market's a lot more volatile, and I think that we do have now the USDA's May WASDE report. The first that includes its first pass at new crop supply and demand. It's come and gone, but every single category, I think, is subject to revision, which is always the case to some extent, but more so than any year in recent history because of trade policy, biofuel policy, and of course, weather, which has been pretty chaotic and stays that way. So feed market's a blank canvas. It's hour to hour. We'll try to guide ourselves and navigate the markets. And our general idea is still one of selling rallies, but also maybe buying breaks. We don't want to get caught into a period this summer where you've got expanding dryness in the US, Europe, Canada, Black Sea region, and all of a sudden the markets look very different. The US and Chinese trade negotiators also seemingly so far successful and still talking. And the reason I think that sort of the headlines do make sense is the tariffs have been not eliminated, but dropped considerably. So in the US today, there's a 30% tariff on most Chinese goods that compares to 145% a week ago. And China's dropped tariffs on most of US goods to 10%. That compares to 125% a year ago. So we're kind of making headways. That relationship is thawing. I don't want to say there's a phase one like trade deal, but like in 2020, we didn't know that it happened until it did. So we got to just entertain scenarios, yield demand wise across the feed space. So we want to be very, very nimble in that market. The late spring theme to us and really into early summer kind of hinges upon three things. One, the U.S.-Chinese relationship is thawing and thawing pretty rapidly. Uh, Trade Representative Greer is in China currently and still talking about things at a very high level. I think the kind of the background here is, we've talked about the last couple of times, the trade war is centered on the U.S. and China, the world's two dominant and largest economies, and fighting for dominance over the next several decades. But the tariffs on both sides, unsustainable. Something has to get solved. China's a little more vulnerable, we know, because of their real estate collapse. Things are doing very, very badly in terms of population growth, economic performance. So I think China, they get a little more vulnerable, and that helps negotiations speed along. But it is important that we're talking. Tariffs are down substantially. Is there hope for China buying more U.S. goods of all kinds? And again, I think this is going to be a monetary formula here. It's not so much that you need to buy 20 million tons of corn, but you need to change the deficit by X billion dollars. That probably will include some food purchases if we get to that point. Point number two is, finally, we talked about this for months now. Just the discrepancy between, in spring or early spring and winter, falling U.S. dairy prices, but soaring world prices. And like a year ago, it meant nothing for kind of March, April, but all of a sudden we are increasing our share of world trade. Dairy exports are performing very well. The snapshot today is the US is either cheaper than it was 30 days ago, or at least the discounts are still very, very wide. So I think export demand will be a dominant thing of the dairy space, at least through summer and into the early part of autumn. It's going to help disappearance, kind of help clear inventories because we are producing more things than last year, but does demand offset that? That's a pretty key issue. Again, like I mentioned, feed markets, a blank canvas. Whether soybean exports in the 25-26 crop year are 1.5 billion bushels, terrible, or 1.9 billion bushels, which would give us pipeline minimum stocks, kind of hinges upon how these negotiations with China move. If soybean yields 51 bushels an acre instead of a record 52 and a half, pipeline minimum stocks. And even corn globally, we're not supposed to be building stocks all that robustly this year, and that assumes normal weather. So if we lose 3 or 4 bushels of yield in the US or in Europe or in Ukraine, the market looks very different. So just be prepared for summer volatility. And I think that's starting to kick in a little more intensely, even today with soybean oil being down to the limit level. So firstly, we do have higher cow numbers, and that was cited in the USDA's May WASDE in terms of their U.S. milk balance sheet. So they did hike U.S. milk production about 400 million pounds to 227.3 billion. That gives us annual growth of 0.6%. We're moving closer to what was normalcy prior to 2021. It's nothing like we've seen, production growth of 2%, but it is moving in that direction. And I think this is still debatable. This is going to be like the grain markets, pretty fluid number. Again, their principal reason for raising U.S. milk production was cow numbers, which makes sense. We did add 49,000 head to the U.S. dairy herd between December and March 30th, 31st. That also kind of seasonal, though. You tend to add cows during the spring months, and then you tend to subtract cow numbers after April or May. So if it is based mostly on cow numbers, I think we could see maybe some downward pressure on the USDA's U.S. milk production forecast. That's really no longer the theme. I think we've kind of digested through pretty weak prices in Q1, very probable, almost guaranteed production growth in the U.S. this year for the first time in a while. At the same time, as the USDA is raising its production forecast, it's also raising cash price forecasts. And we kind of saw this coming. Something we've hinted at is, over and over again, it's very simple seasonal trends. These markets, whether it's crude oil or corn, wheat, or milk, generally rooted in the physical supply of things. And so we know we get a lot of milk sort of late winter into spring flush. Markets typically pretty weak in Q1 and then rallies thereafter. And the same thing with the USDA's price forecast. They can only account for cash trading to date, the futures market to some extent. I think dairy markets have bottomed, and so they're starting to hike production or price forecasts, not to lower them. So we do have an all milk cash price forecast at 21.60 per hundredweight. That's what it was 2 months ago. There's probably a little room to raise this, and I think we all have to pay very, very close attention to what happens in Europe. They're doing very badly in terms of production. Europe is the world's largest cheese exporter, so the increase in the expansion of exports that we've seen recently, I think probably continues. So I don't want to rule out maybe a cash price of $22 a hundredweight or better. Again, if the U.S.-Chinese relationship is thawing, that was kind of the biggest thorn in the side of the dairy markets. Just what does China do? Do they leave the market entirely and go somewhere else? But now I think that's not very likely. Kind of status quo in terms of exports to China. So we're kind of trading fundamentals again. How long can we sustain milk production growth? How much exactly do we export? The domestic market seems pretty healthy. We're the only country with large surpluses. So again, I think the U.S. dairy price forecasts go up, not down over the next several months. Part of, too, I think our lack of negative outlook in the dairy space, and maybe our cautiously bullish outlook is centered on whey to some extent. That market is forging its annual bottom very probably. And doing it at 50 cents a pound instead of 40 cents a year ago in the latter part of April. Seasonally, normally, you kind of add premium to the whey price between now and the end of the year. And so that was the laggard of the space, that non-fat dry a little bit. But if the whey market's bottoming, what's the downside story or the bear story in all milk cash prices? I'm going to tell you just how robust U.S. cheese demand is, and especially U.S. butter demand is. So those aren't going to be the things to drive milk prices down. It's kind of whey and non-fat dry. But the whey market's bottoming. Stocks are not abundant. Whey stocks are down, 15 million pounds from where they were last year, and very likely they start to contract again May, June. So the whey market looks pretty healthy at these levels to us. And also, I think the story, again, if there's one thing to focus on why we have this cautiously positive outlook for dairy prices, it is the export market. And so as the USDA tried to kind of project contraction year over year in 2025 in terms of US dairy exports, that's been evaporated and eliminated completely. We can kind of see, we talked about this on previous signals. US dairy products are very cheap in the world market. January, February, maybe not buying as much as we thought, but that's kicked in full now. US is exporting lots and lots of things and kind of across the board, from fluid milk to non-fat dry, everything is recovering. So the USDA raised production, milk production, about 400 million pounds, but also raised exports a similar amount. So we're the second largest fat-based milk exports on record, if the USDA is correct here. And I think just based again on the snapshot of cash price spreads, seasonality, probably the USDA is forced to raise its, fat-based and probably skim solid-based exports another 200 or 300 million pounds over the next 3 or 4 months. They've got to see the trade data first, but we are positioned to do very well in terms of dairy exports. And that is being shown kind of in the latest data that we get, which unfortunately is about 45 days late. But dairy exports recovered. The balance of dairy trade in the month of March was positive $351 million. That's compared to $285 million in February, the second largest balance of trade for the month on record, second to 2022, when we did not have enough milk or dairy products. So we're starting to match those levels, and I think that's important. Seasonally, you do kind of start to erode dairy exports, and that's just based on the return of Southern Hemisphere production. But we've still got another like 45 or 60 days where the US will be the world's dominant supplier. Exports in terms of quantity were just over 245,000 tons. That's also just slightly below last year, and still very, very good relative to history. So again, we can talk about, or the market has digested this kind of surprisingly large increase in total milk volumes. And we all know we're very, very good at producing components now as well. But offsetting this, and maybe offsetting this almost completely, is the arrival of pretty strong export demand. Cheese exports. Again, we are now one of the biggest suppliers to at least the Western Hemisphere now. We didn't quite beat last year's all-time record, but cheese exports in the month of March were 49,000 tons, just down 1,000 from last year, second largest for any month on record. And this makes sense. This is not some secret that's happening out of nowhere. U.S. cheese is priced to sell today. $1.80 a pound, blocks at least, is where we get USDA volume of sales report tells us. It's still incredibly cheap compared to everyone else. So we're going to have very, very strong cheese disappearance for another couple of months, I think. That's kind of locked in. And maybe it continues, or at least we exceed year-ago levels through the rest of the year, just based on price spreads. And as we'll touch on in just a bit, the lack of improvement in milk production in competing markets. So again, we've talked about butter exports being very good, cheese exports being very good, but I think it's, again, the bottoming of the whey market seasonally, and also the return of pretty solid non-fat dry exports. So all categories are participating now. Mexico and the Philippines in March really stepped up. So non-fat dry exports, 64,500 tons versus 48,000 in February. Kind of back to normalcy in terms of non-fat dry export disappearance. So again, kind of trying to poke holes in this, and what is the story if we're to be overly bearish of dairy products when we've got whey bottoming, export demand improving, uncertainty over cow numbers, at least maybe after May or June, and so uncertainty over milk production. It's a big deal. We've also got a retreating cattle market this week, but also the shuttering of the U.S.-Mexican border in terms of feed or cattle trade. I don't think the beef market's going to be well supplied for a long time. That stays intact. Is that steal cows from the dairy space? Butter exports, again, this is all happening because U.S. butter is incredibly, incredibly cheap in the global market, even at $2.30 a pound, which is not a low price historically. Outright butter exports were 8,300 tons, the largest for the month since 2014. And for the second consecutive month, we were a pretty decently sized net exporter, kind of rivaling the levels of 2021 and 2022. So as we're producing more butter, we're not adding to supplies with net imports, but rather this is adding a few million pounds of disappearance per month, and probably continues, I think, indefinitely. Butter has been cheap for a very long time compared to other origins. Those discounts are getting wider, and I don't think they go away or maybe even shrink for another 90 or 100 days. So Everyone buying butter today from the US probably continues to do it through the summer months. So we're clearing a lot of fat inventories. There are a lot of fat supplies available, but I think we're going to start clearing those a lot easier at these prices. So either US butter stays at $2.30 and we have net exports for the rest of the year, or does the butter market, second half of the calendar year start to think about rationing what we've got, 250, 260. We all know we're going to use an incredible amount of butter in Q3 and Q4. I think once we get to peak monthly inventories, which almost always is June, I think the butter market starts to think about maybe saving some supplies for the domestic market, and that will be done through price. And I think what was kind of surprising, I mean, none of this is terribly surprising given the US discounts, which at certain times offset reciprocal tariffs. Even if tariffs were in place between somewhere like North Africa and the US, you're still saving money buying US cheese and US butter. But China never really left, and that's the big question that we've got. And we were hearing rumors that they were thinking about, or maybe would have gone elsewhere for supplies during summer, but they were going to ship what they had already purchased. Now that the sort of trade tensions have thawed, I don't think we're going to lose China as a major destination for US markets. Because on paper, again, the tariff China has placed on US goods is only 10%, and that is more than offset by lower prices, cheese, butter, even the powder market. So I think that China, I don't know if we're going to see record Chinese import demand, but I think it'll be pretty ho-hum, pretty status quo for the rest of the year, or at least until we get through this 90-day pause in the battle of tariffs that we saw pretty intensely in March and April. So China's here for now. There is the idea that maybe China bought a bunch of stuff prior to the official implementation of tariffs in April, but I don't think that that is the case. I think China has really nowhere else to go for dairy supplies. And given the cash prices in places like New Zealand and Europe, I don't think anyone does. I think that US is the place to buy products because it exists and it is reasonably priced, if not outright cheap. So that's kind of takes us to where we are today. We don't see much improvement in production outside the US. And so European and UK milk production, the European continent especially, growth in production has ended. In the month of February, it was down 1% when accounting for the leap year. In the month of March, it was down 0.1%. So to the point where recent growth in European milk production was only 4 months in duration. Now we're back to contraction. And I think they're dealing with some of the same issues in terms of just the lack of cow numbers. I don't want to say peak milk yield, but like the US, kind of struggling to grow yield when we talk about the volume of milk produced anyway. So this is going to be a challenge. Regulatory issues, lack of available land, maybe some weather or feed supplies. We'll see how the summer performs there. But just wanted to say that, again, the world's largest exporter of cheese, struggling to grow US milk production. And I think what the cheese market is doing now is very economic theory in real time and in real world practice is we're watching the USDA's balance sheets be forced to be reshuffled. So the USDA currently projects European production of milk in calendar year 2025 to be down just 0.2%. Production through March is down 1.5%. So we're watching things sort themselves out with higher US cheese exports, rising cheese prices, soaring cheese prices in Europe and New Zealand. And that's all kind of part and parcel of just the lack of growth in production, which I don't think changes much. Like in the US too, like Northern Hemisphere production, I think this is daylight hours more than anything else. It's going to start slowing come summer. So just the outright volumes of milk available in Europe, like the US, will be shrinking after the next couple of weeks. Europe accounts today for about 42 to 44% of global cheese trade, kind of smashes everyone else, but that's starting to change. I mean, I don't think we're going to match that in the US. We're about 15% of world trade, but even getting that to 16%, kind of a big deal for cheese stocks at some point in the calendar year. That explains why the cheese market's doing so well in terms of finding export demand, bottoming seasonally. The outlook is not negative for the next 4 or 5 months. New Zealand and Australia, which have done very well in terms of growing milk production, up until about the last couple of months, also starting to see kind of a move towards potential contraction during the summer, maybe August, September. Combined Oceania milk production in the month of March was 2.4 million tons, up just 0.5% year over year. And so you see in the graphic here that in August, production was up 6%. Building supplies, taking some market share from the US, but that is not the case currently. I think when you combine sort of the European and Oceania milk production, this bodes favorably for the US's share of trade. This is not something the market will trade in any given week or any given month, but we've hinted at before, we kind of just look at trends, very conservative long range estimates. There's a multi-ton increase in global dairy trade that's forthcoming over the next decade. I don't think today that New Zealand and Europe combined will be able to fill that gap. I think that gap is ours to take if we can increase milk production. So I think over the next 5, maybe 10 years, the US's share of dairy exports globally will be increasing, not contracting. And so again, that kind of shows us why we are where we are. Bottoming markets, export demand recovering, the balance of trade doing very well historically. The snapshot today, very little change. In fact, maybe getting worse in terms of supply and demand outside of the US. So we've talked about the really clear trend in the global dairy market over the last 14 months. It has been bullish. That was also the case in last week's global auction, which this is charted in metric tons or dollars per metric ton, but in pounds, $2.05 per pound. In late April, it was $1.99 per pound. This is also the highest weighted average dairy auction price since the spring of 2022. We're not terribly far from records scored in 2014 and 2022. Again, thinking about the contraction of milk production in Europe, rapid slowing of production in Oceania, seasonal trends in consumption in the Northern Hemisphere start to expand the middle part of summer. So I don't think the global dairy market needs to really shed any premium. I think it rather has to sort out existing supplies. And we've also got to contend with, as in every year, a pretty sharp seasonal downtrend in production in Australia and New Zealand. So they're just not going to participate like they do every year during the summer months. When we separate the product markets too, it's been cheese leading the way. Last week's auction in the cheddar market was pretty incredible. Cheddar was up 27 cents per pound at $2.50 per pound. Again, US blocks last week traded at $1.80 per pound in the cash market. The auction's butter price also scored a new record for a 5th consecutive auction and is now quoted at $3.63 per pound. So again, global markets are moving higher. We've got record global butter prices. I know the US market, I don't know if we can say it's poor at managing forward risk, but I do think it's just kind of staring at what's in front of it today. But we kind of extrapolate trends in consumption over the next 2 or 3 months. I think butter consumption is going to go very, very well. It has been record on a monthly basis, butter consumption, really almost every month since last February 2024. That probably continues for the rest of this year. So again, I don't think that these charts lean bearish of US dairy markets, especially when we all know that the seasonal trend in US dairy markets anyway is pretty noticeably positive between April and September, October. And so here's where it exists. So what do we think that the April export data will say, or the May export data, or June export data? Here is where the US exists in terms of cheese and butter relative to competing markets. So again, block cheddar, $1.80. European cash market quoted at $2.35. Oceania at $2.35 as well. That is a 25% discount. You are saving 25% if you buy cheese from the US instead of New Zealand or Europe. I think importers probably are going to keep buying US origin cheese. US butter, $2.34, been about $2.30 to $2.35, almost since Christmas. That is a 40% discount to Europe and a 30% discount to the Oceania market. So even if tariffs come back or the trade war accelerates, gets exacerbated after the next 90 days, you're still saving money, an incredible amount of money, by buying US butter instead of competing origin butter. So I think that the April, May, June trade data is going to be pretty positive. We haven't seen these discounts in the world cheddar market except briefly in 2023, and compared to Oceania in January 2022, these are unique. These are very special discounts. These are going to find export demand. Look at butter, US butter compared to Europe. Pretty incredible discount, $1.55 per pound. It's just amazing. So I think that US export disappearance stays very, very robust. And the duration is what's important. I think we have to extend the positive export outlook into Q4 if we don't see improvement in European milk output or a correction in price there after about the latter part of summer. I mean, there's a scenario that the U.S. dominates dairy trade as a whole for the rest of 2025. And so the seasonal recovery kicks in. Again, none of this is terribly remarkable. We were asking the question if was weakness in the market in Q1 just normal, or inventories were rising, production going very smoothly, or was it the real loss of Chinese demand, economic slowdown, trade war, tariffs, etc.? But I think it was just kind of normal seasonal evolutions in production and stocks. For now, we're starting to add premium in the butter market, albeit very slowly and steadily. Cheese market doing a little bit better, but if we move forward to about September, October, and we get back to 8 or 10% growth in price relative to January 1st, that's a $2 cheese market. Generally speaking, that's a $20 class 3 market as well. So those are where our upside targets exist. It probably does make sense to pass some of this risk off onto someone else. I mean, look very closely at your P&Ls. If 19.5, $20 class 3 milk works, let's hedge that. But I do think there is upside potential in these markets and maybe some downside potential in feed. So I think things look pretty good, and we're pretty optimistic with respect to the U.S. dairy space. Feed markets, again, blank canvas. It's hard to be convicted that you have an outlook, at least for the next 30, 45 days. Probably the next lasting trend in feed markets centers on weather and the market's perception of yield. Is it bad? Is it good? That defines the market, into October, November. So I have a couple of weeks until we get there, really better understanding what Northern Hemisphere summer climate patterns look like and what they probably do over the next 100, 120 days. So 3 things that the feed markets will center on. None of these things are known today. As of course, always top of the list is weather. Second will be the success of U.S.-Chinese specific negotiations. Again, China's a little more vulnerable this time around, and we all know what happened in 2020. We had positive input, positive coverage surrounding the U.S. negotiating with China in 2018, 2019. Really meant nothing. We had an abundance of supply, but sort of August, September of 2020, they really started to kick in and bought a lot of U.S. products, from dairy, corn, soybeans, and wheat. Kicked off a multi-year bull run. So I don't know if that happens. I'm not saying it's going to happen, but it is something that lingers in the background to the point where we always keep balance sheet yield scenarios. What happens if corn yields 180? What if it's 175? Now we have to do the same thing. I think the market has to do the same thing with exports from the U.S. What happens with U.S. corn exports or soybean exports if there is not a Chinese trade deal or if there is a Chinese trade deal? What is the forward risk in feed markets? So it's very hard to quantify today. And then U.S. biofuel policy, very, very uncertain. Today, soybean oil is limit down after adding about 20% to the price of soybean oil over the last couple of months. That was centered on expectations that we would grow the EPA's mandated fuel volumes for biofuels. And now we've kind of retracted that pretty quickly. So we have no guidance on exactly what the 2026 to 2028 volume mandates will be. Probably won't for a couple of months, but if those are higher or if they are lower, are a big deal to the soy complex especially. Soybean oil will be the catalyst here. The soybeans, do they need to be at $9.80 or $11? That in part will be determined by the EPA's guidance on 2026 biofuel mandates. We just don't know what they are today. The default position, I think, is still, choppiness, volatility during summer, but without a major weather problem. Corn prices probably do work lower, dairy production margins improve. Price action still been pretty unremarkable since harvest, very intense. Maybe the seasonal correction, a couple of weeks earlier than normal, but this has been pretty clear. This is a 15-year average in the performance of spot Chicago corn. So most likely maybe sliding into some neutral choppy trade today. Very close eye on weather, but it's at harvest period. Odds are high that corn prices move lower, and that's just because we're planting 5 or 6 million more acres this year. And also because, like we talked about in the dairy space, this is essentially rooted in the physical supply of things. In no scenario, I think, will there be a shortage of corn globally come October 15th. I think supplies are going to be abundant After that, are they abundant enough? But I do think the cash market's got to contend with the sort of new supplies from the US. Brazil will be harvesting in the next 30 days. Ukraine probably does better yield wise than they did last year, crippling droughts in the Black Sea a year ago. So lots of corn available. Red line probably follows the black line into August, September. But again, do we get a deal with China? Do we get a deal with Vietnam, Thailand, India? What is biofuel policy, and what does Mother Nature give us over the next 3 or 4 months? The May WASDE surprisingly low on new crop ending stocks. So very tight old crop corn balance sheet, 1.4 billion bushels, stocks used of about 9.5%. Historically, we've only been below that in a couple of years. Not going to be a lot of corn in August in the US. The odds of increasing that pile of corn, though, is very high, again, just because of the at least 5 million additional acres and assuming trend yield. But I think this kind of shows us that the USDA thinks a lot of this new corn supply will be absorbed by larger demand. From a big picture, and to keep it simple, importers in the last couple of years have drawn upon stocks rather than importing larger volumes. We in the USDA think that importers come back to kind of restocking mode in 2025, so trade will be higher. Ethanol production in Brazil has exploded, and it's a big deal, and that takes a lot out of the growth in world stocks, even if weather is normal globally. So we're building stocks, but slowly and not very intensely. It's not terribly bearish December corn at something like 410 or 420. If yield is 177, are you back to 1.5 billion bushel in stocks? Those are kind of the questions that we've got. And it just kind of, I think the market's going to have to trade both sides for the next 100 days. I don't think either the bulls or bears will have much leverage. Again, until you know what we've got most likely in terms of yield, that won't happen until the second half of summer at least. The soybean market down sharply today, but again, this just highlights or underscores that volatility will be the theme for the foreseeable future. So opposite of corn, we've lost about 3.5 million acres. So assuming a record US soybean yield of 52.5 bushels an acre, ending stocks dropped to 295. That is not too far above what's considered pipeline minimum. Now, I don't think the market believes that exports will be 1.8 billion bushels, but like I mentioned earlier, maybe it's 1.6. But if there's a trade deal or that relationship with China thaws further, maybe it is 1.8. You lose half a bushel of yield on soybeans and you're down to 240, 250 million bushel in stocks. That's not very much. I think the soybean market's going to trade almost each and every first trade headline, but also every weather forecast that comes out. If there are perceived threats, I think we all have to expect the soybean market to add premium. To that end, things seem to be going pretty well. I mean, we don't have any concrete details, and I want to be clear in saying we think that it's a monetary value the U.S. is after rather than certain tonnage of U.S. agricultural products or anything. But over the weekend, tariffs reduced sharply. This kind of highlights the media landscape on Monday where, markets recovering across the board, crude oil, financials, the ag sector. And they're talking still. So successful negotiations last weekend in Geneva. We hear that, again, Trade Representative Greer is still talking to high-level Chinese counterparts. So we're kind of moving this thing along. And we think that probably China does some kind of goodwill purchase of something. I don't know if it'll be corn or milk or cheese, but spending a couple $1 billion on something in the U.S. does make sense between now and maybe the middle part of summer. And if that's the case, I think that signals that China is willing to play ball. They're buying things for political reasons. Does that raise the odds further that there may be something like a phase one trade agreement? Again, I don't want to plant the seed that we're going back to 2020 US-Chinese ag trade, which was pretty incredible. But just something that you can't disprove today at some point in the next 12 or 18 months. So again, it lingers in the background. It's a big deal. Does China, like in calendar year 2021, spend $44 billion on ag goods? Or is it 23 billion like last year? Or is it current forecast, the best guess is, at least as of last week, something like 16 billion? I think even if China spends $30 billion on U.S. goods, that is supportive of ag markets. And that will include some measure of growth in non-fat dry and whey markets in the U.S. They will buy a little bit more non-fat dry and whey from the U.S. market, and that leans positive of price. So it's a big question mark. What does the 2025 bar in this graphic look like? Prior to the weekend, we thought it would be lower, pretty multi-year low at just $16 billion. But now we can't really rule out anything between 20 and $40 billion. So stay tuned, and we need to be very, very nimble with respect to that. To the point where we've made, even in publishing, our research, we're now keeping two balance sheets officially. And so you see here ARCA, ARCB. One includes no trade deal with China. Things get worse after the next 90 days, and ARCB is a deal is struck. And so this will all be fine tuned. There's a lot of numbers here. They're not going to be exactly correct. But again, we think the range of possibilities for U.S. soybean exports is between 1.5 and about 1.9 billion bushels. So either you have more than adequate supplies, market drops, maybe 950 at harvest, or you have an incredibly tight balance sheet like we saw, prior to 2023. That's an $11 cash price, 11.50 futures. We don't know any of this, but we just have to start entertaining scenarios because of the success so far in U.S.-Chinese trade talks. Similar in corn, I don't think the change in corn will be as robust, but we've got 1.4 billion bushel in stocks projected on September 1st of this year. Maybe that's too high by 50 million. It's going to be a very tight market. But either we think U.S. stocks kind of swell to 2.2 billion bushels, and that's maybe a $3.80 to $4 market, or stay tight at 1.9 billion bushels. That's probably keeps the corn market where it is today. And all of this assumes 181 yield, a record, something we've never done before. It is mathematically feasible, I think, but what does the weather pattern July, August look like given current drought? Does it expand? Does it contract? Again, just wanted to communicate that most likely corn drops into harvest, but a yield of 175, 176 does keep the market as tight as it is currently for the next 14 or 15 months. Again, just have to be very nimble, very engaged in the markets to know how to navigate this stuff. And also, like a year ago, again, this is not going to be something that's digested in any given week or month, but we're still a long way from global oversupply. So if we kind of think back through recent history, 2016, $3.02 per bushel corn, ranges of 3 to 3.40. We thought it was very exciting when we got to 3.80. That was very much rooted in fundamentals. Ending stocks in the U.S., 2 billion bushels every year. There was nothing we could do to tighten our own balance sheet. Surging production in South America, so exporter stocks as a percent of use that we've shown quite a bit, and we think that over time this is the biggest driver of corn price. 14.6% 2016. 13% in 2017. Those markets were oversupplied. We had to send a signal to stop planting things in the U.S., stop planting things in Brazil. That would be more difficult to accomplish. We're nowhere close to that today. So the USDA, in its first pass, projects export of stocks to use next year at 8.5%. That's not very high. We think because of U.S. acreage growth, it may be 9.8% if you assume trend yield. Also high, but not oversupplied. If the U.S. corn yield, just isolate the U.S. balance sheet, is 175, you're back down to 8.2%. That's a pretty supportive number. The corn market's not going to break meaningfully if that is the case. So we've just got to prove that that's not the case, and that's going to be based on weather patterns over the next 2 full months, maybe 3 full months. So be prepared for volatility. Every weather forecast does matter because we don't have a lot of things. We're not carrying over a lot of supply. Forecasts will be changeable every 6 hours. Just be prepared for very, very volatile feed markets. I wanted to say this too, when we're thinking about corn over the next 12 or 14 months, the dairymen have to use it. We're competing with other industries, the ethanol, the export sector. I don't think that U.S. exports will be down meaningfully, even if there is not a deal struck with China. That's partially because the sort of advent of this winter crop in Brazil. And Brazil is getting better at producing corn. For context, prior to about 2012, they were only producing 70 million tons. Now it's 130 million tons. But they're using that domestically. They have really allowed their ethanol industry to explode, and that ethanol is being used domestically as well. So you can kind of see the evolution of this. In Monday's report, in this one report alone, the USDA increased old crop Brazilian corn industrial use by 3 million tons. That is a unique revision to any category in any balance sheet. But you can kind of see and feel this happening in the Brazilian cash market. They are using an incredible amount of corn to produce ethanol. They have already in December, they were at 21 and a half for the 24-25 year. So they've added 5 million tons to ethanol production or corn's ethanol demand draw in Brazil just in 4 months. Their forecast is for growth of 1 million tons. That probably is 3 or 4 million tons too low. So on the right, you see that despite Brazil producing larger corn crops, they're not able to export anymore. I think their exportable surplus probably stagnates for the next couple of years just because they're using so much for ethanol. That's important because you look at like 22, 23, that year, Brazil exported almost 60 million tons of corn. US corn exports went to bare minimum, and that really kind of sparked the end of the bull market in corn. It's just very different in Brazil today. They will be a pretty sizable exporter of corn come August, September, but it's not going to last very long. I think the US still exports quite a bit of corn just because of Brazilian ethanol production and the explosion in that industry. And talking about uncertainty, biofuels, again, kind of just something we're dealing with today. Prior to about 7 p.m. last night, the idea was that the tax reconciliation bill would include one, an exclusion of imported supplies as feedstock to produce biodiesel and renewable diesel. We would allow Canadian product in and Mexican product in. Essentially, we'd allow Canadian canola oil to be used for renewable diesel production, and that was it. The idea was the recent sort of congregation of industry participants recommending a blend mandate in the biomass-based diesel in 2026 of 5.2 billion gallons. Now, I want to show this because the current mandate is 3.35 billion gallons. That would have been a substantial increase, and we can't use really imported products outside of Canadian canola. Soybean oil, kind of the darling of the space until really over the overnight session. Would we have enough soybean oil to kind of meet this stuff? But it's really kind of a really good policy when we talk about wanting to clear excess supplies of U.S. ag goods. This all makes sense. But now overnight, the EPA has said that, well, we're going to take a look at this. We probably won't know anything for 2 or 3 months. The rumor is that the 2026 volume mandate may only be 4 billion gallons or so, with still growth. If 45Z makes it into the tax bill, it's still positive, I think, for soybeans and soybean oil, but just substantially lower than expectations, and the markets shed premium in bulk and very, very quick. That's not to say none of this is policy yet. We could implement 5 billion gallon RVO in 2026, 27, and 28. Maybe we don't. We just don't know. So I wanted to highlight the uncertainty kind of plaguing the biofuel sector until we get something announced. And they've already missed one deadline. I guess the next real deadline would be kind of October, November of this year. Maybe we don't know what the credits will be for renewable diesel and biodiesel production until Q4 of 2025. It's just kind of an issue for the market as a whole. Now we get into weather, and I think what's staring at us in front of us and why the feed markets have been kind of loath to sustain rallies, especially corn and wheat, is we have had, on balance, a pretty rapid shrinking of drought. Wisconsin almost drought-free, maybe some spotty abnormal dryness. Minnesota has done really, really well. And you kind of see across the southern plains and South Dakota drought easing very, very quickly. So an abundance of water. Drought currently covers just 22% of the U.S. Corn Belt. Historically, it's pretty normal if kind of on the lower end of the last decade. No problems with water today. Next 7 days are going to be very, very wet. And so I'm kind of setting the stage that these long-range climate forecasts have been very consistent in calling for drought expansion, especially west of the Mississippi. Heat, dryness, everyone's pretty confident that it happens. But we've got to get the drying trend in place first, and that's not going to happen through the remainder of May. We probably won't cross the bridge that, the need to add weather risk premium until maybe Father's Day or something. You're going to get 2 or 4 inches of rain in a lot of places over the next 7 days. Maybe it's too much in some areas, but water availability will not be an issue outside of, western Kansas and the Texas and Oklahoma panhandles. So that, I think, why we have this generally positive corn outlook, or at least there is a lot of risk in terms of supply. But here today, I think you got to keep your trend yield forecast intact. In as much as May weather matters, it does look like abundant rain is going to fall across the Corn Belt in the next 7 days, maybe the next 2 weeks. But we do want to highlight kind of forward risk. And again, the market's only going to trade what's immediately in front of it, but these have looked similar over the last couple of months. We kind of isolate the June, July, August period. This is the probability of exceedance. So kind of a confidence map from the U.S. Weather Service. So I think it's going to be dry, kind of west of Illinois. And this is how confident they are that that will be the case. Very deep brown, Iowa, eastern Nebraska, southern Minnesota, and southeast South Dakota. Those are pretty big corn areas. So these are in the background. Again, I just wanted to sort of communicate that it does seem like the smartest climate people are not terribly optimistic on favorable weather during the summer. But again, we've got to get to the drying pattern before I think the market cares about any of that. So we have to see this. Confidence generally in a 100-day forecast is not terribly high, but did want to show you due diligence. This is what the summer forecast looks like. Updated this morning. This is NOAA's associated drought forecast for the next 3 months. So Wisconsin, the border of Illinois, no change, drought persists. We hate that. But elsewhere, it looks like drought free for the summer months, and really across most of the Corn Belt. But you do have it continue pretty severely in Nebraska, South Dakota, Oklahoma, and NOAA, in all their wisdom, projects drought expansion across the central and northern plains. So, we'll have to keep an eye on this. I just think that this is a risk. If this happens, if this is exactly correct, you're probably not going to get 180 corn yield or a 52 bean yield. How far below that, we will talk about that on a dairy signal in August, but just some of the risks that do exist for the summer pattern. And to take it a step further, this is a totally different weather model, and it's similar. It doesn't look as dire, but this is the CFS V2 climate model. Hot summer, kind of dry west of the Mississippi. So there's a lot of agreement. Everything's been pretty consistent, but again, we'll cross this bridge when we get to it. But I do think for now, we like at least thinking about hedging forward contracting milk on further rallies. We like soybean meal prices where they are. We have not yet proven, with everything thrown at the protein meal market, it can trade for any length of time below 290 per ton. The milk soy meal ratio pretty high when we look at recent history. And even corn has the milk corn ratio has recovered, so we're above the 2016 to 2023 average. I suspect this gets a little wider, but I don't think feed costs are very high. I think ratios look pretty good. So we do like managing some of this risk, just given all of the uncertainty. The list of unknowns is numerous, and it's pretty much every category of every feed balance sheet, from production to domestic use to exports. Just not quite sure what the next long-term trend will be, and probably won't until the middle of summer. Just kind of lastly, the hay market for the next couple of months probably stays pretty deflated. And this is going to be part of the easing of drought across the southern plains, if nothing else. Abundance of water over the next 7 days, 2 weeks. As of March 31st, the all hay price was $157 a ton. 2 years ago, it was $230. So I think hay prices are attractive, but probably don't really move that much over the next couple of months anyway. So that's kind of where we are. The big picture message, we are positive dairy. We are uncertain on feed markets, and give us a little bit more widening of those milk feed ratios. We're willing to take some action in terms of hedging. So thank you. There's a lot going on today. I think it's going to be a pretty exciting ag market during the summer months. There will be even more to discuss every 2 weeks. But if you ever have questions about risk management of any kind, don't hesitate to reach out to us. We are here to help. And so thank you so much for your time.
Well, Ben, you really took us on a roller coaster ride here today. It felt like one thing's going good and then just look down to the next and it has a different feel. But I mean, I guess that's the game we play when we're in agriculture, and especially in dairy here. But we had some questions that came in, and I'm going to start from the top and work our way down. And this one, I think you pretty much answered, but give us the top one or two as it reads. Is there any obvious reason for the lack of milk supply from other major countries?
I think it's been a long time coming. So I don't think there's a lot of room for herd growth in a lot of places. I think one of the biggest things in the U.S. has been kind of the expansion into the northern plains. South Dakota, for example, just the herd there. You can see Texas as well, just kind of exploding the last 5 years. You can't do that in New Zealand. Can't do that in Europe. So they're just kind of out of land. And then, regulations to some extent. I mean, we don't farm there, so I don't know what the consensus is, but a lot of cow herd shrinkage for a lot of reasons in places like the Netherlands. New Zealand's climate's kind of funny. The risk there is it rains too much. It's an tropical island almost. And so weather hasn't cooperated. So the combination, I think the core issue is just they don't have more room to have more cows. New
I think
Zealand's
that's
genetics, we have heard, are not great, so they're not really increasing yield. They're just kind of stuck. It's just been very, they don't have a lot of room to produce more.
which I mean, it's an interesting problem for them to have and to take a look at. But next question here reads, what percentage of beef comes from Mexico, and how much of this beef ban will impact U.S. prices?
I don't know offhand the beef number, but I know the feeder cattle numbers. It is about 5% of the total U.S. feeder cattle herd is imported from Mexico. So I think that's a pretty large number. You know, especially in a year like this, if you were to lose 5% of feeder cattle numbers, then you're stuck in this. I know we're at a very high price, so to say it's bullish may be challenging, but beef prices are going to stay elevated. Cow prices are going to stay elevated until this ends. And yeah, it's the second time we've gone through this, so it doesn't seem like it's going to be solved in the short term. The U.S. is working very actively to at least kind of lock down, prevent it from spreading in the U.S. You know, step one was shuttering the border, also kind of setting up task force laboratories and things to make sure that should it cross, won't have much of an impact. But for now, I think the loss of Mexican imports is pretty significant. The second thing that we didn't touch on is drought in Mexico. So they've got disease in their feeder cattle herd, and I think the feed market there is going to stay pretty expensive. No rain, summer's coming. That's another challenge for the amount of cattle coming across the border to the U.S. So 5% of feeder cattle in the U.S. come from Mexico.
Okay, thank you. Next question here reads, does the U.S. have enough milk supply to keep up with the export demand?
We do, yes. I think that's yeah. They're offsetting today. The question that we've got is we need to monitor very closely. Does the cow herd start to shrink nationally, like it normally does after about April, and to what extent will be one question. And then you still have the yield issues. I mean, we every month we alternate between yield contraction and yield growth. I know there's more to it than that. That's just the volume of milk. But I think for now we do. But since we are the only place growing milk production, that's why it's helping our exports, recover from last year. I think there is again, we'll talk about this in a couple of months, but there's a scenario in that if you don't see sustained herd growth, if the national milk yield's still pretty middling, about Q4, the question's a little different. Maybe it does kind of start to get very, very tight. But between now and the end of summer, we will, but it is offsetting, I think.
Okay, and I know you kind of touched on this well here a moment ago, but this next question here reads, do you have insights on the overall tightness of milk supplies?
Yeah, I think generally speaking, the market's starting to look forward. So cheese stocks and butter stocks are going to go up for the next 60 days. So cheese stocks may kind of match last year, in June. Butter stocks may be like a multi-year high on June 30th. I guess the insight that we've got is they're going to start contracting thereafter. And it's that rate of contraction that matters most. So I think the markets are not physically tight today, but we're starting to entertain, you keep cheese exports at or near records, and we're a net butter exporter, you kind of start to accelerate the drop second half of the calendar year. So yeah, not physically tight today, but it's the idea that we could be dealing with some pretty tight markets come autumn.
Well, Ben, that was the last question that we have for you. So thank you so much for your time here this afternoon. As always, it's always much appreciated to get your insights, especially as there's so many moving parts going on right now in the world of agriculture.
Pleasure's mine. I enjoy it very much.
Okay, and for those who are wondering what's going on in the world of professional dairy producers, I'm actually going to reference, Ben said, and he was talking about New Zealand there for a second. Well, if you want to get on that trip in February, we have, and I believe 4 spots left. So we are almost sold out. So if you are on the fence, now is your time to get on that trip. And you can do so by heading over to our website at pdpw.org or giving us a call. But as always, we've got a lot more other great things coming up. So head over there to learn more about our upcoming programs. Thank you for joining us here this afternoon, though, and we'll see you here next week on the Dairy Signal. Bye now.